The market is all green, loving what we got, the news we got from the Bureau of Labor Statistics today on inflation. I'm going to explain why that is. We're going to dig into the report. First of all, we're going to talk about what the report showed and how that compared to expectations. We are going to dig into and do a deep dive on some of the core components of the report and talk about why the market is having such a strong positive reaction to this CPI report. Of course, we're going to talk about the market reaction across market stocks, bonds. We're going to get in commodities a little bit. And I think currencies today are showing us a very big reaction. We'll talk about all of that. And then we'll talk about the big takeaways, kind of big picture, look at what this means in the big picture for inflation, markets, the economy, all that good stuff. And then we will talk about what comes next because of course here on Market Takes, we are always looking forward. So listen, let's get into the report. The headline, CPI showed inflation rose just 3% year over year for the month of June and 0.2% month over month. That is down from 4% year over year and 0.1% month over month. Want to put up here on your screen a chart so you can just take a look at what we're seeing. So as you see there, this is a 2-year chart going back to June 2 years ago, June back in 2021 all the way into 2022 and 2023. As you can see there in 2022, inflation really starts to pick up, and that big peak right there in the middle of your screen, that is June 2022. That was when inflation rose 9.1% year over year, and we are comparing this reading to that. So when we talk about year over year, we're talking about comparing inflation in June that just happened to inflation 1 year ago when that peak, when that bar right there in the middle is at its highest point. And so that's what we're talking about when we talk about, year over year. So inflation's up 3% from that time. Now, this is the lowest reading we've had, 3%, since March of 2021, 6.1 percentage points below the June 2022 high. So we are 6.1 percentage points below that 9.1% we saw in June, that pie bar you see, the top bar on the top of your screen. And we are really comparing going back to that report. Now, this was better than expected, and that's why you're seeing a lot of bullish momentum in markets. One thing I want to point out in all this bullish momentum and all this excitement is the base effect. And when you're coming off of a high base, well, it's harder to go even higher when you're coming off that high base. So again, we were at that peak of 9.1% a year ago. When you compare to that only 3% higher, that takes a little bit of the shine off, but again, really still a strong report. And this just illustrating the overall theme that we have seen, which is inflation continuing to come down from that high point that we saw about a year ago. And that's really, why we're seeing some of this come down. And I just want to temper that bullish enthusiasm. Don't want to disregard it. Don't want to say, oh, there's no reason to be excited. There are reasons for markets to be excited, and we will talk about those in just a moment. But I do want to make sure that we are looking at this with the proper context and understanding that back in June 2022, inflation was rising at 9.1%, and we are comparing to that report going back a year. So make sure you keep that in mind. It could be interesting. Now, my man Greg Dacko, the chief economist at EY Parthenon, he said something very interesting on Twitter, and I want to relate that to you right now. He pointed out that we're seeing rapid disinflation, in his words, but, quote, the free lunch from lower energy prices and easing food and goods prices inflation is largely over. And further easing will have to come from slower core services inflation momentum. Now, we have not really seen that slowing core services momentum. And what we mean by that is what's going on in restaurants where the pandemic really slowed everything down. Folks got laid off, lost their jobs. They're just now getting back in the swing of things. We really haven't seen workers even in that sector get back to where they were pre-pandemic just yet. And so we are seeing prices rise steadily there, and that's the inflation the Fed is more worried about. We are seeing energy prices really turn lower and really bring down the overall impact of the inflation. We are seeing a lot of the food prices that we saw really picking it up and taking this skyward a year ago, that's coming off. Well, so those goods prices now, and when we were seeing those supply chain issues, that's all turning around. And we are seeing services really push inflation higher, and that's the thing that's got to come down. And that's what Greg's talking about when he talks about what we need to see for inflation to continue moving back toward the Fed's 2% target. Remember, the Fed's target is 2%, not 3%. We are much closer to 2% now than we were a year ago, obviously, when inflation was 9%, but we are still a ways away. And that's what the Fed is going to have to be concerned about, getting to the hard part. Let's dig into this deeper dive a little bit. And one thing I want to throw up here on your screen is a core CPI inflation, just a chart of that so you can see the movement there. Now, we know when we look at that CPI chart, you see just, inflation goes up and then it comes back down. Here you're seeing a bit more of that wave pattern. And we saw even last couple months where inflation picked back up unexpectedly, where you saw a rise in this core consumer price inflation. Well, if you look there on the right of your screen, that is the lowest report that we have seen, or the lowest number that we've seen since 2021. Core CPI came in at 4.8% this month year over year and 0.2% month over month. That was the smallest 1 month increase in core CPI since August 2021. Now you compare that to expectations for 5% year over year and 0.4% month over month. The core increase was also about half of what was expected. So even core CPI, which had been the big worrisome effect, or the big worrisome piece of the report, is coming back down now, where you see, and you see that chart, or that number there on the far right of your screen, of that bar getting down below 5% for the first time since 2021. So that chart really just illustrating again that overall CPI is moving in the right direction for the Fed and for consumers. We don't want those prices to keep rising, going up higher, or the pace of those price increases to keep rising higher. So we're seeing the pace come down even on that core number, and that is definitely good news. Listen, the big picture is the year-over-year CPI inflation is now driven almost entirely by core services, including housing, and by food. Food prices are still going up pretty quickly, but everything else is coming down and pulling that overall pace of inflation down. That core CPI year-over-year figure, it's down 0.5% from a month ago on a year-over-year basis, and 1.8 percentage points below the high in September 2022. So listen, that's big. Energy has been a negative contributor, excuse me. We're seeing energy prices fall when you compare to a year ago, and we're seeing core goods now being a slight positive, as in goods prices, what you buy at the store, things you go out and get at the grocery store, stuff like that. Those have been an overall negative, as in bringing inflation further down. And we just got to see that housing piece come down as well. So think about where we were a year ago. Gas was about $5 a gallon, right? Nationwide, approaching that $5 a gallon level. If you were in California, you were seeing $6, $7, $8 prices. And Russia had invaded Ukraine a few months before, and we had really seen those food prices spike. Other supply chain issues were still plaguing companies. You couldn't get things as quickly as you wanted, and so those orders, those prices were rising. Things were taking a long time. You couldn't get new cars. There were still a lot of those semiconductor issues. That's what we're comparing to. Now we've seen a lot of those issues kind of go away. We've seen gas prices come down. And we know when gas prices come down, that's an input to just about everything out there in the rest of the market. So as those prices have come down, overall prices are coming down, and we are seeing now we're at about a 3%, at least on the CPI, gain year over year in terms of how fast prices are rising. Core services, or CPI services versus good, you've got core services rising about 0.3%. Core goods were negative 0.1%. Shelter, the largest share of the increase again, accounting for about 70% of the rise. And we know we've seen real-time indicators of rent prices going down, but we have seen housing prices going back up. That's going to be a big piece of CPI going forward, and inflation going forward, is what happens with housing prices. That's going to put that spotlight squarely on housing costs, those new home prices, those existing home prices, housing starts, all those things that we've seen kind of starting to pick back up and move higher. We saw a big blowout increase in new home sales just last month. We are going to see if that continues. That's something we'll certainly be watching for here on Market Takes. The U.S. core services prices, excluding housing, rose 4% in the 12 months through June. That was the slowest pace of increase since December 2021. On a monthly basis, they were unchanged or flat, the weakest reading since September of 2021. So listen, these are all good things. These all mean inflation is coming down. Those prices that you're seeing at the grocery store, at the pump, at the retail store, really everywhere you look, those are starting to come down and not rise as fast as they had been a year ago. That's definitely a good thing for the market and for the overall economy. Speaking of the market, let us take a look right now at what we're seeing across the board in the markets. I want to throw up here on your screen just a chart of what we're seeing on WSJ.com. You see right there the NASDAQ up 1.35%. Could be a big day for those tech stocks on the NASDAQ. The S&P 500 up clearly 1% early on, but the index jumping to start the day. As you see there, a lot of green across the board. I want to take a look at bonds right now because that's where we're seeing a lot more action. You look at the 10-year Treasury note, those yields are way down, and we're down well below 4%. We had approached over 4%, moving towards 4.1% actually earlier this week, and we have really clearly reversed that trend. If you look here in the so-called belly of the curve, the 3, 5, and 7-year, these yields around the 2-year mark, those have come down. You see the 3-year down almost 19 basis points. That is a huge decline. That's where it shows not just the expectations for the economy, but also what the Federal Reserve is going to do. There's a lot of movement in this area in the interim, right? Where it's about Fed policy, but it's also about the growth of the economy. It's also about inflation. And we're seeing those bonds tell us, hey, people are expecting way less inflation. They're expecting much lower inflation. And that is a really big and a good sign, really, for the overall economy, because you don't want these yields up around 4.5%, 5%, as you see down here on the 6-month, the 3-month. So in the short term, folks are still expecting the Fed to be raising those interest rates, keeping interest rates high. But after you get out past about 2 years, you're seeing the yields down around 4.3, 4.1, and this 10-year note down around 3.89, down about 8-9 basis points right now on the day. That's a big move. Now, I talked about currencies. Let's take a look. This jump in the euro is big. The euro taking off against the dollar, moving up to 111. Now, for those of you who don't follow the currency markets, the euro is the biggest input to the value of the dollar. Really, how the euro moves against the dollar is how most currencies move against the dollar, and we are seeing the value of the dollar decline significantly, the value of the euro going up. To look at that another way, let's take a look at the WSJ dollar index. You're seeing the dollar index way down about 1%, and the dollar has been very strong, and that's been on expectations. The Federal Reserve would have to keep raising U.S. interest rates, that inflation was going to stay high. You are seeing that come off in a major way right now when you look at the dollar index and the value of the dollar overall. This is the WSJ index. That measures the dollar against about 16 currencies from around the world. The U.S. dollar index, that's that DXY, that measures the dollar against, I believe, 6 different currencies, the big ones: euro, Japanese yen, the Swiss franc, a few of those, and the Canadian dollar, of course. But the WSJ dollar index measures against both. You're seeing them moving about the same amount. The dollar very clearly going down. Now, when we look at commodities, last thing I want to check, crude oil, that's jumping. That's a good indicator of some bullish momentum. You've also got gold up around 1%. You've got copper, aka Dr. Copper, up in a big way. You see moving higher after we got that CPI report this morning. So, as I said, these numbers just illustrating the overall movement of the markets, and we're seeing across the board green. This is a bullish indicator really for assets across the spectrum, as we can see. So the biggest takeaway, or the biggest surprise, I think, was the big significant decline that we just saw across the board. There were no red flags in this report. You're seeing core services come down. You're seeing the price of housing, which was expected because, again, it's a lagging indicator, that's staying high, but the Federal Reserve and other economists expect that to come down as those newer numbers get added in. We know it takes a while for the new housing prices to get added in, and that's expected to come in and bring inflation down even more moving forward. So the big takeaway from this report is there's just been an overall decline in inflation that's very good, but make sure and pump the brakes. We are comparing to a very high month of inflation a year ago when inflation was really at its strongest, a 40-year high, when folks were kind of losing their minds. If you remember June of 2022, when we got that report in July, man, folks lost it. That was an unexpected increase, and we are comparing to that. So make sure and keep your hat on your head, keep cool, don't overreact. Next month is really where we will see whether this is moving in the right direction, whether this continues to move in the right direction when we don't have a big, huge very high month to compare it to, or as high a month to compare it to, because we know inflation kind of steadily declined rather than just falling off a cliff immediately after June. But we are comparing to an incredibly high month with incredibly high inflation, and that's a big part of why this report looks so strong today. So what to look for next? Well, let's watch those services indicators, right? Indicators of the services economy. We'll look for things like PMI reports, those Purchasing Managers Index reports that come out from the Institute of Supply Management and the S&P Global, right? Those are going to be out later this month. Those are going to tell us what's going on specifically in the services industry. What's going on at restaurants, bars, barbers, lawyers. What are folks in that economy doing? We will see those reports later on. You're going to want to watch for those. Also, you're going to want to watch real-time indicators. Banks like JP Morgan, Citi, Wells Fargo, they track these closely. They put out reports. They'll tell you whether reservations are being made, whether prices are rising, what's going on with prices of a bottle of beer at the bar, what's going on with those things. You'll want to watch out for those. The Fed will certainly be watching out for those coming forward. That's going to tell us what's next for inflation. What's next for us? Well, we will be back here on Monday doing market takes. Looking forward to that week. Bank earnings are out on Friday. We will get reports from JP Morgan, Citigroup, and Wells Fargo. They're going to tell us a lot about the economy. And of course, there will be questions about what this CPI report, if it matches up with what they're seeing in their debit and credit card data. So we have a lot to learn this Friday from those earnings reports. Also, as we look forward to next week, we got a lot more reports. We're going to tell you what earnings report to watch out. Earnings season is really kicking off in a big way, and this CPI report really sets us up for a lot of bullish momentum on the stock market. You're seeing those bond prices come down, which means bond prices are going up. Oil prices coming back up. That could be something that you really are going to want to watch for. So stick with us. We'll be right back here at 10 a.m. Monday morning on Market Takes. Make sure you don't miss it. Don't be that's a square, don't do it. And we also have, of course, the retail sales report coming out next Tuesday. Listen, I am Dion Rabowen, reporter at the Wall Street Journal. I know you could have been anywhere else, but you're here with me, and I appreciate that. We will be with you again next time.